Yeah, the big thing, Matt, really I think at this point is the Fed really is more focused on jobs right now. I mean, you got to think like inflation went completely out of control. Like there were some
Hmm.
what nines and tens readings in there. I mean, they were very
Hmm.
brief, but it happened. We're back in the twos now. Like inflation, I think is less of the concern at this point. It's the jobs. It's the fact that
Hmm.
the economy still feels overheated because people aren't losing their jobs yet. And again, we're in this weird industry. It's like where we're deep down cheering for some pain in the economy, right? Like we want a bad jobs report. Well, a bad jobs report means a lot of people lost their jobs, right? It's this weird counter thing where for rates to start to go down, there needs to be some pain in the economy. The tariffs are probably going to create pain in the economy. I think there were some headlines recently like there's going to be short-term pain in the economy because of the tariffs, and that short-term pain may be just what it takes for the Fed to start cutting again. The other thing that's interesting is the Fed stopping cutting also puts the economy in more jeopardy, right? One of the big concerns is that if the Fed doesn't cut fast enough, they can actually create a recession. And so when one of the Fed cuts happened, I think it might have been the first Fed cut that we saw last year, mortgage rates actually got worse because the fear was, oh, the Fed cut too much too fast. They're going to reheat the economy or they're going to stop us from going into the recession maybe we thought we were heading toward. So now we're in a situation where the Fed has paused, right? Last week, the Fed had the first meeting where they've paused cutting interest rates. So now there's no more thought of, oh, the Fed's going to continue to help the economy stay strong by cutting rates. Nope, the Fed has stopped. Then at the same time, we have tariffs being put in place, which can hurt the economy, particularly in the short term. Again, long term may be the best thing for the country. I'm not getting into that, but in the short term, it's going to cause some pain. So we have the Fed stopping cutting rates, which causes pain. We have the tariffs go into effect, which causes pain. And there needs to be a little bit of pain to get rates to really come down. The 10-year Treasury went back up, even though the Fed kept cutting, because the thought was there's not going to be enough pain. There's not going to be job losses. The economy isn't going to suffer. And that's really what drives mortgage rates down. So, again, we're in this interesting place right now where we're waiting to see what happens. How is the long term impact of the tariffs? What's the long term impact of the Fed pause? And the funny thing is, where at some points we're cheering for a rate cut, the fact that the Fed didn't cut may have been the absolute best thing for mortgage rates and the 10-year Treasury because it created that little bit of extra doubt and uncertainty about where the economy is going. So again, really complex stuff. We want you guys to understand that as best we can. I mean, again, and these are my opinions. This is my thoughts. I've been in this game for a long time. Again, none of this is guaranteed. We could see a crazy jobs report come out, at the end of this week on Friday. We could see a terrible jobs report come out on Friday. Like everything is so data dependent right now. But I guess what I want everyone to understand is the tariffs themselves were not a data point that made rates get worse. And the Fed not cutting actually didn't make rates get worse. Rates got a little better after the Fed didn't cut. So some of the things that maybe headlines are saying would create one impact are not, but there are definitely things out there that can send rates going one way or the other, primarily around the inflation items that are not impacted by the tariffs and not impacted by housing and the overall jobs market and the jobs report.